Hello, and welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies for MetaTrader 5 and study how they actually think. Today we're looking at an expert advisor called the Directional Flow Reservoir. It's an original system built entirely from raw price data, with no classical indicator drawn on the chart. Instead, it models the market as a leaky reservoir that slowly fills with directional pressure and then drains it away. By the end of this video, you'll understand exactly how it reads that pressure, how it decides to enter, and how it decides to step aside. Let's dive in. So what exactly is the directional flow reservoir, and how does it approach the market? At its heart, this expert advisor is a study in one simple question. Is the market actually going somewhere, or is it just busy going nowhere? To answer that, it works only from raw open, high, low, and close data. There are no moving averages, no classic oscillators, and no support and resistance lines drawn on the chart. Everything is computed by hand from price itself. The idea is borrowed from physics. Imagine a reservoir, a tank that slowly fills with what we might call directional pressure. Every time a bar closes, the strategy measures how far price actually traveled compared with a typical bar's range. If price made strong net progress in one direction, the reservoir fills a little more on that side. If the bar was just churn back and forth with nothing to show for it, very little is added. And critically, the reservoir leaks. Old pressure decays away over time, so the level always reflects recent behavior rather than ancient history. When the reservoir climbs clearly above what its own recent range considers normal, the strategy reads that as a genuine directional regime and looks to trade in that direction. When the level drains back towards zero, it treats the move as finished and stands aside. Because it measures everything in units of a typical bar, this approach is self-scaling. It can be applied to different symbols and different market conditions without redrawing fixed levels. It trades both long and short with symmetric rules, holds only one position at a time, and sizes its risk from current volatility. In study terms, it behaves like a trend and momentum following system. Remember, this is educational analysis only and not financial advice. Let's walk through the machinery step by step, exactly as the code does it. There are 4 building blocks. First, the strategy measures typical churn. It takes the average of each bar's high minus low over the last window bars, which by default is 20. This gives a characteristic activity budget, a sense of how much a normal bar moves on this symbol right now. This number is used purely as a scale, never as a signal by itself. Second, it measures directional flow for the bar that just closed. It takes the change from the previous close to the current close and divides it by that typical range. The result is a clean, dimensionless number. A value near 1 means the bar produced a full range's worth of net travel in one direction, which is high conviction. A value near 0 means lots of movement, but no real progress. Third, it charges the reservoir. The new reservoir reading equals the retention factor, default 0.85, times the previous reading, plus the fresh flow. This is what engineers call a leaky integrator. Steady one-sided drift charges it up, while two-sided chop lets the leak pull it back towards 0. Fourth, it builds a self-calibrating confidence band. It takes the standard deviation of the last window reservoir readings and multiplies it by the threshold value, default 1.2. In violent conditions, that band widens on its own, so the strategy demands more before acting. In calm conditions, it narrows and stays responsive. No fixed threshold is ever hard-coded. Now the rules. The strategy signals along when the reservoir is above the positive band and is still rising compared with the previous reading, meaning the pressure is charged bullish and building. It signals a short when the reservoir is below the negative band and is still falling, charged bearish and building. Exits come in 2 ways. The first is what the code calls a reservoir release. If a long is open and the reservoir drains back to 0 or below, the pressure that justified the trade is gone, so the position is closed. The mirror applies to shorts. The second exit is a hard volatility stop and target. The stop distance is set at stop ATR multiple times the ATR, default 1.5, and the take profit is placed at the reward to risk multiple of that distance, default 1.8. Both breathe with volatility, and the system never adds to an open position. Let's read the actual MetaQuotes code on screen, just as you'd see it in MetaEditor. At the top are the inputs. Window sets both the churn scale and the reservoir window. Retention is the leak factor, where higher values give the reservoir a longer memory. Threshold K is how many reservoir standard deviations count as significant. ATR period, stop ATR multiple, and reward risk ratio shape the stop and target, and lots is the fixed position size. Below the inputs is the decision core. The variable named band is threshold K times sigma, the self-calibrating confidence level. The Boolean go-long is true when the reservoir is greater than the positive band and greater than the previous reservoir reading. So the pressure is charged bullish and still building. The Boolean go-short is the exact mirror. The reservoir is below the negative band and below its previous reading. The variable risk is stop ATR multiple times ATR, the stop distance in price terms. In the long block, the strategy buys at the ask price, places the stop 1 risk distance below entry, sets the take profit at the reward to risk multiple of that risk above entry, and then calls trade.buy. In the short block, it does the reverse. It sells at the bid, places the stop 1 risk distance above, sets the take profit the same multiple below, and calls trade.sell. Notice how both sides are perfectly symmetric. The only differences are the direction of the comparison and which way the stop and target are placed. Everything else, the sizing, the risk model, the reward ratio, is identical for longs and shorts. This is educational commentary on the code, and not a recommendation to trade it. Now let's bring it all together on the chart. Below the candles you can see the reservoir plotted in its own panel, oscillating around a central zero line, with an upper confidence band above and a lower confidence band below. Watch how the reservoir and the price move together as the story unfolds. On the opening candles, the market is balanced. Price drifts slightly lower in small, overlapping bars, and down in the panel the reservoir sits close to zero, wandering inside the confidence bands. This is exactly the churn state the strategy is designed to sit out. There's plenty of movement, but no net progress, so no signal appears and the strategy simply waits. Then the character of the market changes. A candle closes firmly higher, and the next one extends the move. Each strong close feeds fresh positive flow into the reservoir, and you can see the reservoir line climbing quickly in the panel. On the buy entry candle, the reservoir pushes clearly above the upper confidence band, and it is still rising compared with the previous reading. Both conditions are met at once, charged bullish and building. That is where the buy entry marker appears on the chart. At that moment, the strategy defines its risk. The stop loss is placed 1 ATR-based risk distance below the entry, and the take profit is set further above at the reward to risk multiple, which by default is 1.8 times the risk. So the target sits nearly twice as far away as the stop. Now watch the move develop. The following candles continue to close higher, one after another, each with real net travel. The reservoir stays elevated, well above the band, confirming that the directional regime is intact. Price advances steadily until it reaches the take profit target, and the take profit marker prints on the chart. The long trade is complete, closed at its predefined target rather than on emotion. After that peak, the market turns. Price stalls at the highs, then begins to roll over. In the panel, the reservoir starts to fall. It drains back down through the zero line, which is the strategy's release level, telling us the bullish pressure has fully dissipated. But the strategy doesn't stop there. The selling continues, fresh negative flow pours in, and the reservoir keeps sinking. On the sell entry candle, the reservoir drops clearly below the lower confidence band, and it is still falling compared with the previous reading. Once again, both conditions line up, this time mirrored, charged bearish and building. That is where the sell entry marker appears. The risk model works the same way in reverse. The stop loss goes 1 risk distance above the entry, and the take profit is placed the reward to risk multiple below it. From there, the down move extends. Each candle carves a fresh low, the reservoir stays pinned below the band, and price slides toward the target. When it reaches the take profit level, the second marker prints, and the short trade closes. Step back and notice the rhythm. The strategy did nothing while the market churned. It committed only when the reservoir broke out of its own self-calibrated band and was still building in that direction. It rode each move while the pressure held, and it defined its exit in advance through both the reservoir release logic and the fixed volatility stop and target. Long and short are handled with the very same rules, just flipped. Of course, not every signal behaves this cleanly. Real markets produce losing trades too, and the confidence band and the stop loss exist precisely because losses are a normal part of any strategy. This walkthrough is an illustration for learning and not a forecast. And that's the directional flow reservoir. We've covered the core idea of a leaky reservoir of directional pressure, the four building blocks of churn, flow, the reservoir, and the self-calibrating band, the symmetric long and short entry rules, the reservoir release and volatility-based exits, and how the code puts it all together in MetaTrader. I hope this gave you a clearer picture of how a purely price-driven, momentum-following system can be constructed from first principles. If you found this useful, please like the video, leave a comment with any strategy you'd like analyzed next, and subscribe so you don't miss future breakdowns. You can find more educational content at www.algobot.live. Remember, everything here is for educational purposes only and is not financial advice. Past performance does not guarantee future results. Trade responsibly.